The 4% rule has been the gold standard for retirement withdrawals for decades. But in today's market, with inflation, current interest rates, and longer retirements, is it still safe to follow? Let's talk about it. Could sticking to the 4% rule actually hurt your retirement plan? In this video, I'll walk through what the 4% rule really means, what it was based on, and whether it still works today. Is there a better way? Is there a smarter way to withdraw your retirement income? Let's get into it. I'm Bry, the Retirement Guy. When I started helping people back in 2009, I noticed something. Nearly everyone had the same goal: peace of mind, wanted to know they're gonna be okay. But most were relying on outdated rules and generic advice not tailored to them. Fast forward to today, we've worked with over 1,000 clients, we've crafted over 1,000 retirement plans, and we oversee over $470 million. What I've learned is this: rules like the 4% rule can be useful rules of thumb, but they need context. My job is to give you that context and a plan that fits your life, not just math on paper. Let's take a closer look whether the 4% rule still belongs in your retirement plan today. Let's first talk, what is the 4% rule? 4% rule is based on a study from a financial advisor in the 90s. He analyzed historical data and found that if you withdrew 4% of your retirement funds in the first year and you adjusted that for inflation each year after, you had a high probability of not running out of money over a 30-year period of time. Here's the example. You retire with $1 million, you withdraw 4% or $40,000 a year, and you increase that percentage each year by inflation. Sounds pretty simple, right? But here's the thing. This rule is based on very specific conditions that doesn't always apply today. Here's why the 4% rule worked back then. The study assumed a balanced portfolio of stock and bonds. It also assumed a certain historical return pattern and interest rates. In the 90s, bond yields were where they were, stock markets were strong, and inflation was relatively stable. And lifespans were shorter than they are today, as we all know. Back then, 4% gave retirees a decent buffer. Fast forward to today, people are living longer, and many are spending 30 or even 40 years plus in retirement. Bond rates are where they are. Market volatility, or the big ups and downs, are more frequent and more extreme. Things are happening a lot quicker, and inflation is staying higher for longer. These factors make the 4% rule feel less like a guideline and more like a gamble. The danger of poor market returns early in retirement is a real risk. Withdraw too much during a downturn and your portfolio might not have the funds to recover. That said, the 4% rule isn't dead just yet. It can still be useful as a starting point or a baseline, especially if your lifestyle is flexible and you can be nimble, or you could reduce spending during market downturns, or even if you're using a dynamic withdrawal strategy, choosing which buckets of money and what the pecking order of your withdrawals should be. If you've built other income sources like rental or pensions, that could help your cause. But using the 4% rule or a fixed rule without adjustment, that's where people get into trouble. Here are some modern strategies that we use for our clients that might complement the 4% rule. A guardrail approach. Instead of withdrawing a fixed percentage every year, we have a ceiling and a floor. If markets do well, you take more money out. If markets drop, you scale back on your withdrawals, allowing that money to re-earn itself. Number 2, try a bucketing strategy. We call it the BML way. We divide your retirement savings into different buckets. We have your short-term bucket, which is your emergency funds, your middle-term bucket, which is your conservative funds and bonds, and your long-term bucket, which is your stocks and your mutual funds. This helps manage sequence of returns risk and allows your investments to recover while buying you time. Number 3, tax smart withdrawals. Coordinating which accounts to pull from and when can dramatically increase income sustainability and help making sure your money lasts longer. Number 4, a custom plan. We've created the retirement fingerprint, not a one-size-fits-all rule, just a personalized plan based on your spending, your assets, your goals, and your health. The real question isn't, should I follow the 4% rule? It's, how do I make sure I don't run out of money in retirement while still living the life I want? This means planning for market declines. Hopefully there's lots of recessions in your retirement. That means you're gonna live a long time. Planning for healthcare costs, the second biggest cost in retirement, and planning for the number one expense in retirement, which are tax changes. And don't forget longevity. We're all living longer. You need a strategy that adapts to your life, not just a fixed formula. So is the 4% rule still valid? Look, it's a decent benchmark, but on its own, it's useless. You deserve more than a one-size-fits-all retirement plan. You deserve a flexible, personalized income strategy that evolves with you and for you. If you want to build a retirement plan based on more than just rules of thumb, subscribe and hit follow to our channel. I break down real-world strategies every single week. I am here for you. If you haven't seen my previous video, How Much Do I Really Need to Retire? Check it out next. It ties perfectly with what we talked about today. This is Brad the Retirement Guy. Thanks for watching.